Imagine you're the CFO of a thriving manufacturing company, Stellar Works Ltd, known for producing top-notch metal products. You've got a stellar reputation, modern facilities, and a skilled team. Business is booming, or so you think. But then, out of nowhere, you stumble upon a troubling issue, an inventory overstatement. Suddenly, the numbers you've been relying on to gauge your company's success are called into question. It's like finding a crack in the foundation of a building you thought was solid. How did it happen? And more importantly, how do you fix it? Let's break it down. Inventory overstatement refers to the misrepresentation of inventory values on financial statements. When you report higher inventory levels than what actually exists, you create a skewed perception of your company's financial health. This can happen for a variety of reasons. Maybe it's a simple data entry error, or perhaps it's a more serious case of intentional manipulation. Either way, the consequences can be disastrous. First, let's talk about the unintentional overstatements. These often stem from common mistakes, miscalculation, misunderstandings of accounting principles, or even just plain old data entry errors. Picture this: your team is busy, and someone accidentally types in the wrong number while inputting inventory data. Suddenly, what should have been a straightforward process spirals into a major issue. Without robust internal controls in place, these errors can go unnoticed, leading to inflated inventory values that misrepresent your company's financial standing. Now, on the flip side, we have deliberate overstatements. This is where things get murky. Intentional manipulation of financial records can happen for various reasons. Perhaps there's pressure to meet quarterly targets, or maybe someone is trying to impress investors. Whatever the motivation, these actions can lead to inflated revenues and asset values, ultimately deceiving stakeholders about the company's performance. The repercussions of overstatement are severe. For starters, it distorts your company's true financial position. Investors, creditors, and analysts rely on accurate financial statements to make informed decisions. If they're basing their judgments on inflated figures, it can lead to misguided assessments and potentially disastrous investments. Trust is everything in business, and once it's lost, it's incredibly difficult to regain. Moreover, overstatement can skew your key performance indicators. Let's say your inventory turnover ratio is artificially inflated. This could lead management to believe that inventory is moving quickly, prompting decisions based on false premises. You might find yourself overproducing or misallocating resources, which can directly impact profitability and operational efficiency. It's a slippery slope that can lead to missed opportunities and wasted resources. Regulatory bodies are also on the lookout for financial misrepresentation. If your company is found guilty of overstatement, you could face hefty penalties and fines. The legal consequences can be even more severe, with lawsuits and criminal charges potentially damaging your company's reputation beyond repair. So, how does overstatement occur specifically within inventory management? One common culprit is errors in recording and tracking inventory transactions. Maybe your team miscounts stock, or there's a misunderstanding about how to document inventory movement. Inadequate internal controls can also play a significant role. If there's insufficient supervision or verification of inventory counts, it opens the door for both errors and intentional manipulation to slip through the cracks. Now, let's take a closer look at the specific impacts of inventory overstatement. When you inflate inventory values, you're not just misrepresenting your assets, you're also affecting your company's profitability measures. Higher reported inventory can lead to inflated gross profit margins, giving stakeholders a false sense of security about your financial health. Consider the current ratio, which measures your company's ability to meet short-term obligations. If your inventory is overstated, this ratio may appear more favorable than it truly is, misleading stakeholders about your liquidity. Similarly, your inventory turnover ratios could be skewed, making it difficult to accurately assess your operational efficiency. In the case of Stellar Works Ltd, the inventory overstatement was a wake-up call. The company discovered significant discrepancies during a routine physical inventory count. When the actual count didn't match the recorded figures, alarm bells went off. This prompted an in-depth audit to uncover the root causes of the overstatement. Through this investigation, Stellar Works identified errors in recording and tracking inventory transactions, along with misapplication of valuation methods. The company quickly realized the need for corrective actions. They strengthened internal controls, revised their inventory management processes, and implemented more rigorous monitoring and reconciliation procedures. This brings us to the critical step of detecting and controlling inventory overstatement. What are the warning signs you should be on the lookout for? Excessive inventory levels without a corresponding increase in sales can be a red flag. If you notice a sudden spike in inventory that doesn't align with your sales trends, it's time to dig deeper. An unusual inventory turnover ratio can also indicate potential overstatement. If your turnover is abnormally low or inconsistent with industry norms, you might be sitting on unsold or obsolete inventory that's artificially inflating your balance sheet. Inadequate internal controls are another major concern. If your company lacks segregation of duties or fails to conduct periodic reconciliation, the risk of overstatement increases significantly. Frequent discrepancies during physical counts should also raise suspicions. If your team is constantly making adjustments to reconcile inventory figures, it's a clear indication that something is amiss. So, what can companies do to detect and control inventory overstatement effectively? Regular physical inventory counts are essential. By comparing actual quantities with recorded figures, you can identify discrepancies and ensure that your inventory values reflect reality. Robust internal controls are non-negotiable. Establishing strong controls, including thorough documentation of inventory transactions and periodic reconciliation, is crucial in minimizing the risk of overstatement. Leveraging technology can be a game changer. Implementing inventory management systems and software can enhance accuracy and streamline processes. Automated systems provide real-time tracking of inventory movements, reducing human errors and generating reliable reports for analysis. Data analytics can also help you spot patterns and anomalies in inventory data. By analyzing trends in inventory levels and turnover ratios, you can identify potential areas of overstatement before they become significant issues. Once Stellar Works identified the overstatement, they took immediate action. They recorded a write-down entry to decrease the value of the overstated inventory, ensuring that their financial statements accurately reflected the true state of affairs. They also adjusted their cost of goods sold to match the reduced inventory value and made necessary adjustments to retain earnings. After reissuing their financial statements, Stellar Works demonstrated their commitment to transparency and integrity. They communicated the adjustments to stakeholders, reassuring them that they were taking the necessary steps to rectify the situation. In conclusion, navigating the pitfalls of overstatement in accounting, particularly in inventory management, is crucial for any manufacturing business. By recognizing the causes and consequences of inventory overstatement, companies can take proactive steps to detect and control it. Implementing robust internal controls, conducting regular physical inventory counts, leveraging technology, and ensuring the proper application of accounting principles are essential strategies to mitigate risks. If you're a manufacturing business seeking expert guidance in bookkeeping, accounting, and efficient inventory management processes, consider reaching out to CFO Consultant LLC. Our experienced professionals specialize in supporting manufacturing businesses like yours, ensuring accurate financial reporting and optimizing inventory management practices. Don't wait for a wake-up call. Take the necessary steps to maintain accurate and transparent financial records today.